Welcome to the Master Passive Income Show. My name's Dustin Heiner, and I'm here to help you learn how to quit that JOB, that just over broke job, by investing in real estate. And as well as I brought on a fantastic expert who started a fantastic way for us to save for our real estate investing. Brett Sons, thank you so much for being on the show.
Yeah, thank you so much for having me. I look forward to this chat, and I've watched a few of your podcasts, and I like what you guys are onto, and I have a little bit of real estate exposure myself, so I completely appreciate the passive income concept.
Man, this is great having you on. Now, when we first started talking about what you're doing with your company, now, full disclosure, I am an investor, meaning I bought shares into this ETF that we're going to be talking about. But the reason why I bought into it, because I really think it's a fantastic service, as well as being able to save money and make dividend, which I love passive income, buying something or doing work one time and then making money over and over again. So now, Brett, tell us about LifeGoals and what you have that will help us to save money for a down payment on a property.
Absolutely. And Dustin, thank you so much. We appreciate you being one of the investors in the home down payment ETF. And to your point, it does pay a monthly dividend, and it's currently paying about a 2% annualized monthly dividend. So you get that coupon every month, which is exciting for anybody that's invested. So why don't I just start with how this company actually came about? So my brother and I both have worked in the asset management industry, which is a fancy way of just essentially saying we work for the big companies that select the stocks and bonds that go into investments across the world, quote unquote, on Wall Street, right? We worked there for the last combined 25 years. And last year, I actually had my down payment saved. I was getting ready to buy a house, right? Actually build a house. My wife and I were going to move a little bit outside of town and build a house. What ended up happening is COVID hit. My wife and I said, well, we better not start to build the house now, because we could get laid off from our jobs. We actually don't know how much house we can or can't afford, right? Naturally. I said, wait a second, actually, we're going to have a big recession because of COVID. You're going to get a crash in the economy. We should be able to build the house for dramatically cheaper than we would have been. And we live about 3 hours due north of Manhattan, right? Straight up the Hudson River in a town called Saratoga Springs. What actually ended up happening during COVID is a lot of people moved out of Manhattan, like other big cities across the country, and bought up all the homes in the countryside, essentially, in the smaller cities. And instead of me buying or building a house for less than the cost associated with it, exact opposite happened, and it backfired in my face, right? So we had home prices go whoop, right, to the tune of 16.5% is what the price inflation was in the housing market across the United States last year, right? 16.5%. That's mind blowing. I said to myself, well, I got my down payment, right? And I'll just use a round number. I've got my $100,000 from my house sitting at the bank. It's yielding approximately zero. Home prices went up at 16.5%, right? So my $100,000 didn't go down in value because it's still $100,000, and there's not a lot of yield at offer right now at the bank, right? It's less than, it's like 1/10 of 1%. But I lost 16.5% of my purchasing power. So, I'm looking at myself, I'm going, this equation does not work, right? My wife, we have a young baby, we need a house to move in, we got to move outside of the condo and get a bigger place. So there's a lot of people in the country that have the same predicament that we do, where they have their down payment sitting at the bank and they're watching home price inflation across the country go up at 16.5%, a mind-blowing number, right? Just for context, it was high last year. The 50-year average home price inflation in the United States is 5.4. So 5.4 is still dramatically higher than what you get at the bank, which is zero. My brother and I, who both have investment backgrounds, both work in the asset management industry, we said, well, maybe we can get a little bit more sophisticated here with the down payment and figure out a way to potentially offset some of that home price inflation. So we put our heads together and we came up with, okay, we'll buy stocks like Home Depot, Lowe's, lumber companies, potentially home building companies. Those, if there continues to be home price inflation, in theory, those are just examples, but in theory, those type of stocks should continue to perform well and potentially offset some of that home price inflation. But the problem is you can't go out and just buy stocks with your down payment for your home, right? Say me, the round number that I picked, $100,000, I can't put all $100,000 in the stock market because, as we know, the stock market crashes from time to time. So my brother Taylor and I, the co-founder of LifeGoal Investments alongside me, we said, well, there's got to be something out there. Let's go on Google, right? So we went on Google and we looked for something that has a way to save for a down payment for a house or any piece of real estate for that matter. We came up with nothing, right? So then we went out and we hired a patent attorney to do a search for us. They came back with nothing after they charged us a nice handsome fee, right? As you know. So then we said, okay, well, we've got the investment background. Let's build this thing. And we thought about how to put it together. The most efficient way to put it together is in an ETF, right? So the beautiful thing about ETF, an ETF or an exchange traded fund, think of an ETF or an exchange traded fund as the modern version of a mutual fund, right? A lot of the benefits of mutual fund where there's diversification, but it's the modern version and the idea that there's no cost to buy or sell. You could buy it 1 minute, sell it the next. Nobody's going to penalize you. You could buy it on Robinhood. You could buy it on Fidelity, Schwab, anywhere where you transact and buy stocks. You could go and you could buy it there with the same exact process, which makes it very accessible for everybody across the country. So Taylor and I said, okay, let's use our investment background and our network to build something that everybody in America can use that is free to buy or sell to achieve their home down payment goal exactly like I did. And all I'm showing is on our website, which is lifegoalinvestments.com. You could also follow us on Instagram, lifegoalinvestments.com. It's simply the About Us tab. And this is important because we know that there's a challenge out there for people buying homes or trying to buy homes and get that down payment. The question is what's the solution, right? And if Taylor and I and LifeGoal Investments thinks that we're bringing a solution to folks like yourself and other folks out there across America, you better know a little bit about us to know if we're qualified to do so. So Taylor and I are both MBAs, right? We both are CMAs, which is a certified investment management analyst. And then Taylor's also a CFP, which is a certified financial planner. And that, along with the combined 25 years we spent on Wall Street working for essentially the wealthiest families in the world, helping them construct the perfect portfolio, we took all that knowledge and put it into building what we think is the perfect solution for somebody to help them achieve a home down payment. The ETF that we're referencing, and again, it's an exchange traded fund, right? LifeGoal Home Down Payment Investment ETF, ticker HOM, just like the house that you, house or home that you want to live in. It's a risk score of 2 out of 5. I'm just going to go around real quick and explain to folks, one, what's in this ETF, because there's thousands of stock holdings inside of this ETF. There's thousands of bond holdings inside of this ETF, and there's over a dozen different commodities inside of this ETF. So I'm going to explain what's in there, and then I'm going to explain why it's in there. So just quickly going around the horn, I'll highlight the parts on the pie chart here. It says a little over 40% US bonds. And bonds are just a conservative investment to help dampen the volatility of portfolios. So we'll go to there, international bonds. An example of an international bond could potentially be a Brazilian bond. That could have potentially, anywhere between a 0 and a 10% yield, right? They could have very high yields when you go to some of the international bonds. Global infrastructure. What's an example of global infrastructure? Think about like a toll road in Japan, or potentially the Panama Canal, or a toll bridge on I-95 in New York, right? It's critical to the infrastructure of whatever that given society is. So global real estate, we all on this channel know all about real estate. Guess what? They've got real estate over in overseas as well, and they can be great investments, right? They provide income, they provide diversification. You think about a piece of property in London, as well as a piece of property in Manhattan or Los Angeles. They may have no correlation to each other, but both provide positive returns, which is exciting. Commodities, as I mentioned, think about things like gold. They could dampen risk potentially. Covered calls are in here, which is an income generating strategy. US Treasuries. So think about US Treasuries. The example of what we have in the portfolio is actually an ETF that holds US Treasuries. As an example, in the big crash of 2008, US Treasuries were up, longer dated US Treasuries are up over 20%, right? So you've got things in the portfolio here that are designed to work during different parts of the economic cycle to hopefully bring ballast to somebody trying to create a down payment. And then you've got US stocks, and I'll give a couple examples of those stocks here in a moment. And then you have international stocks, right? Think about, potentially a technology company in China, or a cattle company in Brazil, right? There's companies all over the world. When you couple them together, you could potentially generate good returns with offsetting risk. And as a whole, this portfolio is approximately 25% stocks, about 5% bonds, and then about 65 to 70% fixed income, right? And the question we often get when asked that is, why is the portfolio weighted the way that it's weighted? And when I say weighted, what percent is in stocks? What percent is in bonds? I did my certified investment management analyst at the University of Pennsylvania Wharton School of Business. We spent a week there studying with the professors to go with several extremely complex tests in order to get that designation. 1, 2, 3, 4, 5, 6 different portfolios. One of the portfolios on the bottom part of the screen is 100% bonds. And then the other portfolio up in the top right-hand corner of the screen is 100% stocks. And it looks a little bit like a boomerang, where the bonds are low risk, and then you go up higher and higher and higher, and you get higher risk and higher return, essentially. But what this is showing is actually, people would often think bonds are less risky than stocks. So having 100% bonds would make a portfolio less risky than having a little bit of stocks potentially in there with the bonds. And what this efficient frontier chart is showing you is that this portfolio that happens to be 28% stocks and 72% bonds is just, and this is just an example, guys. It's typically about 75-25. About 75% bonds and 25% stocks actually is lower risk than 100% bonds. So you look at our HOM ETF that Taylor and I have designed for people to help achieve that down payment. Why did we pick about 25% stocks and 75% bonds? Because that's approximately the lowest risk portfolio when you look at the academic studies in the efficient frontier chart that I'm referencing right here. So I know I'm hammering you over the head with technicals, but there's a reason why we did the things the way we did them. And about 25% stocks and 75% bonds. If you look back at the academic research, historically, that's provided approximately the smoothest ride, right? The smoothest ride. And that's what we want to deliver anybody that's trying to potentially buy a down payment. So lastly, touching on, so we said that there's about 20% US stocks in this, right? Going down the list here, you can see on the left-hand side of the page. These are examples of stocks that are actually in this ETF as of 9/30. So you see Lowe's at the top, 1%, then Home Depot, we're going down the list, slightly lower exposure to each. Zillow, Sherman-Williams, Stanley Black & Decker, Carrier Global, that's an air conditioning company. Lennar, that's a home builder. Toll Brothers, that's a home builder. Williams-Sonoma, people are familiar with that. Masco, that's another home builder. Owens & Company, home builder. Whirlpool, that's your refrigerator and your appliances. Floor & Decor, Trek Decks, that's what most people are building their decks out of these days. And then the last one, Blue Group, is another home builder. But what we've done here is we've brought stocks into the portfolio that are directly associated with the costs in the real estate market, right? So I think it's pretty simple for most people to be able to wrap their head around. If home prices keep going up in the United States, that's because there's a lot of demand for homes and not enough supply to match that demand. If that equation is playing out, there's going to be a line at the cash register at Home Depot because people need to buy 2x4s and hammers in order to build more homes to offset that demand, right? So it's likely that you would get a decent return pattern from Home Depot and Lowe's and stocks along those lines. Again, those are just examples that happen to be in the portfolio today.
And so, Brett, I love the idea that we are profiting from when the market's going up, because right now it's definitely going up, and we want to make sure that we're not losing money, but at the same time we're making money. But at the same time, what happens if there's a correction in the market? Like 2008 was rough, or obviously for real estate, but also economy in general. Do you have protections in there for in case something does take a turn?
Yeah, great question, Dustin. I'm glad you're thinking a couple steps ahead because as you know, the COVID crash that happened in the market wasn't long ago. So the way we designed this portfolio is we essentially went out and we took one of the most successful investment strategies on earth. It actually happens to be by a hedge fund. It's the hedge fund. This is the biggest hedge fund in the world. It's called Bridgewater Capital. It's run out of Greenwich, Connecticut. And the gentleman that founded it, his name's Ray Dalio. And Ray founded a strategy that has been widely accepted by institutions across the United States, the deepest pockets across the United States, and frankly, the deepest pockets across the world. And this strategy is actually referred to as a risk parity strategy. Risk parity. What does that mean? It means we put equal amounts of risk in 3 buckets, right? The first bucket is what type of securities do well in an expanding economic scenario. That's typically stocks. What type of securities do well in a contracting economic scenario? That tends to be bonds, especially US Treasuries that are guaranteed by the US government. Those tend to do well. As an example, as you mentioned, well, 2008, we had the big crash. Last year in COVID, we had the big crash. Long dated treasuries, 20 and 30 year US Treasuries were up 20% and 30% respectively during those markets. So the stock market was down, the US Treasuries were up 20 and 30%. And then lastly, that third bucket are securities that tend to do well in an inflationary economy, right? And that can be things along the lines of real assets, which could potentially be gold, commodities, corn, lumber, things along those lines. Also inflation protected US Treasuries, they're called TIPS, or even real estate, right? We have real estate in the portfolio. So going back to Ray Dalio, he patented that strategy that he uses in his all-weather hedge fund. That's the biggest hedge fund in the world. And it's built that way because it's all weather. It's very hard to predict what's going to happen 6 months from now. And because of that, we've put both securities in the portfolio that tend to do well during a growing economy, a contracting economy, as well as inflationary economy. And it's a great point that you brought up. And then the other thing that I'll mention, and you've alluded to this already, is dividends, right? Everybody loves dividends. Inside of the HOM ETF, as well as the other ETFs we run, we tend to focus on stocks that grow their dividend or look to grow their dividend every year. You know, they look to pay a penny more every year, whatever the incremental amount may be. So if you were to get a scenario where the stock market's down a little bit, hopefully those dividends continue to be paid. And but again, we've got about 65% bonds in the portfolio, the HOM ETF. And those should hold up. Those should hold up relatively well in a contracting economic scenario.
Yeah, because that's something that I'm always concerned about. And in fact, any investors, number one, we want to make sure we don't lose money. That's the biggest thing. You know, if we're going to invest in something, we don't want to lose that money. But the second thing we worry about is, are we going to make money on that? And like you said at the beginning, if you put your money in a savings account, you're literally making next to nothing, like zero. In fact, inflation's already like 5% right now. That at least that's what the Fed is trying to tell us. It's 5% right now, which if you have your money in savings accounts, you're literally losing 4%, if not almost 5% a year, just having it sit there. So this is a fantastic way, in my opinion. That's why I put my money inside this ETF, because I'm going to store it here, and it's better than any savings account or even most CDs. It's going to be better than that. So what I like about this is because I can store it there, but it's also liquid in a sense where I could literally just sell it tomorrow and buy it tomorrow and just I use Robinhood as well as TD Ameritrade and other things, but it's literally, I mean, is there certain places, like, should we go with any brokerage account should be able to get it?
Yeah, it's available across all the big brokerage accounts out there. Any, you could buy it anywhere. Let's put it that way. Even if you had a Morgan Stanley financial advisor or, Merrill, UBS or whatever, you could say, hey, would you buy this on my behalf? I think it's actually referred to as an unsolicited trade. So you would say buy ticker HOM unsolicited, or you go on Robinhood. Most of the people are doing it themselves these days. You go on Robinhood, Schwab. The ETF today, HOM, it yields approximately 2%, right? So you mentioned CDs. CD, you're looking at a yield of less than 0.5% most likely. Savings accounts, you're looking at approximately 0.05, so less than 10%, or pardon me, less than 0.1%. And the total return for this ETF, the targeted total return, is we're attempting to offset home price inflation, right? So we're not trying to put up 15, 20, 30% returns per year. We're targeting that 5.4%. That is the 50-year average home price in the United States, right? This year and last year are an anomaly. You're gonna have a spike up, and then it's gonna slow down, or it's gonna level off, and it'll probably get back in line with that 50-year average, because frankly, there just aren't enough homes in the United States at this point. So if we can get you 2% or 2% give or take from the yield of the portfolio, again, that's that dividend of the portfolio should pay you on a monthly basis. And then we can get another 3-ish, 4-ish% of capital appreciation. And that comes from buying stocks, that in theory would go from trading at 10 inside of the ETF to then they're trading at 20, right? We have several different stocks inside of the portfolio that could potentially go up in value, as well as commodities that could potentially go up in value. And that's how you get a scenario where you potentially have a greater return than just the dividend itself. And that's absolutely what we're targeting. And Dustin, hey, I haven't bought my home yet, so I'm in there with you, brother. I've got my down payment in there. We have 4 other ETFs that are also out there that have similar goals like this, that just happen to be very similar from an investment perspective. They're all-weather portfolios, if you will, approximately 25 to 30% stocks. One is related to raising kids, and kids are expensive, as you know. It's ticker CHLD. The other one is associated with going on vacation. It's ticker SUNY, SUNY. The other one is just a general savings strategy. It's the ticker SAVN, SAVN. It's not FDIC insured. It is an investment. It's an ETF. It could go up and down in value, but the ticker SAVN, and we designed it. It's our most conservative investment out of the 5 ETFs we have. And then lastly, we have the Wealth Builder, which is a more aggressive instrument. It's for long-term money. You would, put your retirement dollars in there, things like that. So, but the HOM is our flagship. The HOM is why this company was founded. My brother and I and the folks that backed us from the investment side are very proud of this idea. We think that we'll be a household name here over the coming years because there's a crisis in the United States. People can't afford homes. How are you going to afford them sitting in a savings account and getting zero when home prices are going up? Right, you're not. So you need to do something. And if you're not doing it, your next door neighbor is doing it, or the next door neighbor in the rental is doing it, guess what? They're going to be ahead of you because they're going to grind out hopefully slow and steady returns and beat you to the punch. And the average, according to CNBC, they just put out an article. It takes the average person 6.5 years to save for a down payment, right? That was with home prices going up at 5.4%. Last year, they went up 16.5. So it's going to take people longer to get to that home down payment now. So what we'd like to think is that we can help society get into a home quicker, embrace the American dream, and maybe we could get them there. We're not looking to take out undue risk. This is undue risk. This is an all-weather strategy, but maybe we can get them there a little quicker if they were to consistently buy into the HOM ETF, and the HOM ETF does what it was designed to do, which is hit singles and doubles and target that home price inflation, which is 5.4% over the long term.
That's great, Brett. Okay, so everybody watching this and listening to this on the podcast, definitely check out the ticker symbol HOM. Just pull up Robinhood. Robinhood and type in HOM, find that. You can see everything that they're doing. They're definitely, obviously, very, very open about everything. Check out their website as well. But Brett, thank you so much for this great insight and sharing with this and creating this for us, because savings accounts are for suckers. And so hopefully we'll be able to be smart enough, put our money in good places where it's actually going to give us a good return. So thanks, Brett. I really appreciate being on the show.
Yeah, thank you, Dustin. And thanks to all the folks that follow you. This is an awesome network.